It's that time of year again. You've worked hard, saved diligently, and now you have a lump sum of cash that you want to put to work for your retirement. With the end of the year closing in, the pressure's on to make the smartest move. And for most seasoned investors, the play feels obvious, almost automatic. But what if that safe and familiar decision is actually the biggest mistake you could make with your money this year? Most investors think they're being clever by putting their year-end savings into a traditional IRA or 401k to get that immediate tax deduction. But in the next few minutes, I'm going to show you why that could be a huge misstep and reveal the one account strategy that could generate thousands or even tens of thousands more in pure tax-free growth. Sticking to the old playbook could be costing you a fortune, and you might not even realize it until it's way too late. But first, I'm Brad Lineberger, certified financial planner and founder of Seaside Wealth Management, helping you get more out of life with your money. If you'd like guidance on building a financial plan for retirement from a trusted fiduciary, use the link in the description below to book a free strategy call with one of our advisors. Let's be honest, when you've got extra cash to invest at the end of the year, your first instinct's probably to lower the tax bill. Conventional wisdom screams, use a traditional 401k or traditional IRA. Logic's simple and seductive. You contribute pre-tax money, your taxable income for the year goes down, and you get a nice tax refund or a smaller tax bill in April. A clear win. And for some people, it's not a bad move. The immediate tax break's a tangible reward for saving, but the whole strategy is built on one giant assumption about your future, an assumption that can be completely wrong. And that assumes that you'll be in a much lower bracket in retirement than you're at right now during your peak earning years. Think about that for a second. Are you sure that's true? The entire point of saving and investing is to build a nest egg that generates a comfortable income in retirement. What happens if your investments do really well? What if tax rates go up in the future? All of a sudden, that big pile of money you've built becomes a huge tax liability. Every single dollar you pull from your traditional 401k or IRA gets taxed as ordinary income. You didn't avoid taxes, you just postponed them. You might end up paying them on a much, much larger scale down the road. And this subtle flaw in the old way of thinking can have massive consequences. So what if we flip the script? Instead of asking how to get the biggest tax break today, what if we ask how to get the biggest tax-free income in retirement? This simple shift leads us to the most powerful tool for many smart investors, the Roth account. Whether it's a Roth IRA or a Roth 401k, the principle is the same, and it's a total game changer. With a Roth, you contribute after-tax dollars. Yes, that means you don't get the immediate tax deduction. It might feel like a small loss now, but what you gain later is monumental. By paying your taxes up front, every dollar of growth that your investments generate over the next 10, 20, or 30 years is completely 100% tax-free when you take it out in retirement. All of it. Let me give you an analogy. Imagine you're a farmer. You can either pay tax on a small bag of seeds that you're about to plant, or you can pay tax on the enormous harvest that you reap from those seeds decades later. Which would you rather choose? Paying 24% tax on a $7,000 seed today is one thing. Paying that same 24% or maybe 30 or 35%, depending on future tax rates, on the $100,000 harvest it grows into is another thing entirely. The traditional strategy is to pay tax on the harvest. The Roth strategy is to pay tax on the seed. The difference in your final take-home wealth can be absolutely staggering. As a financial advisor for 20 years, I've seen this play out time and time again. And in my former life as a firefighter, it was all about prevention. And so now I apply that to financial planning, where if we can do a little prevention, in this case, preventing your tax bill from being too high in the future, it goes a long, long way to keeping more money in your pocket. But don't just take my word for it. Let me give you an example to bring this thing to life. Meet two different investors, Mark and Sarah. They're both 50, they're in the 24% tax bracket, and each has an extra $7,000 to invest. Mark follows conventional wisdom, and he puts his $7,000 into a traditional IRA. This gives him a tax reduction of $1,680, lowering his tax bill for the year. Feels good. He invests the money, and over 25 years, it grows to an impressive $75,000 over time. Not bad. Assuming he's still in the 24% bracket, he'll owe the government $18,000 in taxes, His net after-tax gain from that single investment is $57,000. Now let's look at Sarah. She goes with the Roth strategy. She contributes $7,000 to a Roth now. She gets no tax deduction today, passing up the immediate $1,680 in savings. Her $7,000 invested also grows to $75,000 over the years. But when Sarah starts taking withdrawals, her tax bill is zero. Zip. The entire $75,000 is hers to keep, completely tax-free. Let's compare. Mark got a quick $1,680 benefit, but ended up with $57,000. Sarah gave up the immediate perk, but ended up with $75,000. She's $18,000 wealthier from this one decision alone, just because she chose to pay tax on the seed, not the harvest. Now imagine that effect multiplied over decades of contributions. This isn't a small tweak, it's the key to a truly tax-free retirement. Right about now, some of you are probably thinking, Brad, this sounds great, but I make too much money to contribute to a Roth IRA. This is where we get to the so-called secret that savvy investors use to get around this rule. For 2025, your ability to contribute to a Roth IRA is limited by your income. The contribution amount starts to phase out if your modified adjusted gross income is between $150,000 and $165,000 for single, or $236,000 and $246,000 if you're married filing jointly. And if your income's above those limits, you're eliminated from contributing directly. But there's a completely legal method that we use for our clients known as the backdoor Roth IRA. It sounds complicated, but it's a simple two-step process. Step one, you contribute to a non-deductible traditional IRA. There's no income limits for this type of contribution. And this year you can contribute $7,000 or $8,000 if you're over 50. And step two, shortly after the money in the traditional IRA is contributed, I'm talking a few days or weeks, you convert that entire amount to a Roth IRA. Since you made the first contribution with after-tax money, it was non-deductible, and the conversion itself is tax-free. You'd only owe tax on any tiny bit of interest that the money earned while it was sitting in the traditional IRA, which is usually just a few dollars, if anything at all. And that's it. You've successfully funded your Roth IRA for the year, even though your income is technically too high. This is the move that lets high income earners get in on tax-free growth. One huge warning here though. This strategy is cleanest if you have no other pre-tax IRA money, like from an old 401k rollover. If you do, a tax rule called the pro rata rule kicks in and can make the conversion partly taxable. So if you have other IRA assets, you absolutely need to talk to a financial advisor before doing a backdoor Roth. For a great video on the backdoor Roth strategy, check out what we made here. So how do you put all this together into a smart strategy before the year's end? Here's your step-by-step blueprint. Step one, the no-brainer. Get the full 401k match. So before you do anything else, contribute enough to your company's 401k to get the full match. It's a guaranteed 100% return on investment. Not doing this is like leaving free money on the table. Step two, the tax-free growth engine. Max out your Roth IRA. After securing your match, your very next dollar should go to maxing out a Roth IRA. For 2025, it's $7,000 or $8,000 if you're 50 or over. And if your income's too high, this is where you can use the backdoor Roth strategy that we just covered. Step three, supercharge your savings. Go back to the 401k. Once your Roth IRA is full, circle back to the 401k and contribute as much as you can, up to the 2025 max of $23,500. And if your company has a Roth 401k, consider using that to build up more tax-free dollars. Step four is what I like to call the age 50 and above power up. Use those catch-up contributions. If you're 50 or over, the IRS lets you save even more. You can put an extra $1,000 in your IRA for a total of $8,000 and an extra $7,500 in your 401k. And new for 2025, if you're between 60 and 63, you can save an extra $11,250 to your 401k, bringing your total to $34,750. This sequence, match, Roth IRA, max 401k, catch up, is the best path for building a resilient, tax-efficient retirement fund. So I hope you found this helpful, and make sure that you're taking advantage of these steps before the year end. I know things get busy. It's the holidays. There's a lot going on. I get it. I've got 4 kids. I'm married. I know there's always a lot going on, But these are the little things that you want to take care of that are going to set you up for success for 2026 and beyond. Stop what you're doing. Make sure that you fund your retirement accounts now. Take care of business, and we'll see you on the next one. But before, take a look at this. I think you'll really enjoy it.